In a recent interview with the founder of Liquid Death, he mentioned that the way they came up with the brand name was by asking themselves, what's the dumbest possible name for a super healthy, safest beverage possible? And that's how they came up with the name Liquid Death. The idea was to stir controversy and attract attention, both online and at the stores, when customers walk across the shelves and see this name. Then they built a marketing machine behind this brand and succeeded in building the brand and a following base online that is now higher than any other water brand. They managed to get people to pay almost $2 for 500 ml of water, which can easily be bought at 30 cents. And this is the power of branding. And the differential amount in value that you can get from successful branding campaigns is called brand equity. Brand equity can come in many forms. It could be in the form of charging higher prices for the same products, such as the case in this example, and also the case with many luxury brands. It could also be in the form of positive consumer reaction and trust when they see the brand name on a certain product. It could also be in the form of higher market share. And it could even be negative. And this is when consumers react negatively to a product when they see a certain brand name attached to it. So why would you want to build brand equity for your business? For many reasons. For one, positive brand equity gives pricing power, which translates into higher margins and profitability for your business, as well as the ability to survive during times of high inflation. This brand equity also helps when you launch new products by giving them the same brand name and giving them a powerful head start just from the brand equity you have already built in your older products. And another important advantage of brand equity is that this equity is actually a valuable asset that can be quantified and added to your company's value. For example, when Amazon acquired Whole Foods for $13.7 billion, that was $9 billion higher than the actual value of the net assets of Whole Foods. The difference was recorded on Amazon's balance sheet as goodwill. Reflected in this goodwill amount is the brand equity of Whole Foods and its ability as a brand to attract and retain customers with relatively higher purchasing power than other grocers. So it's safe to say that the time and money you invest in building brand equity comes back to you multiple times over.